The new tax bill is here. And during today's episode, I'm going to be teaching you why it's more important now than ever for you to have an LLC in 2025. This tax code is full of huge deductions and tax strategies for business owners. And if you don't have your business set up, you could be missing out on all of these deductions. All that plus more on today's episode. What's up, family? Welcome back to another episode of Tax Free Living. I'm your host, Cofield, and today we have an amazing episode. We're going to be talking about how LLC owners can win this new Trump tax bill. And I'm going to be going over 5 different strategies or reasons why you need to have an LLC in 2025 to be able to take advantage of these new strategies in the new tax bill. So, number 1 is the return of 100% bonus depreciation. So back in 2022, that was the last year that we had 100% bonus depreciation. And back then we saw influencers everywhere buying G-Wagons, buying these cars that weighed over 6,000 pounds because they were able to write off 100% of the value of that vehicle the year that they purchased it, even if they didn't spend any money out of pocket. So they were able to finance the vehicle, maybe put a little bit of money down, but they were able to write off 100% of the cost. Since 2022, bonus depreciation has went down by 20%. In 2023, it was 80. In 2024, it was 60. And in 2025, it was supposed to be 40%. But with Donald Trump's recent tax bill, it was reinstated back to 100% bonus depreciation, which means that if you purchase a vehicle over 6,000 pounds, you will be able to write off 100%. But here's the thing I want you all to understand. 100% bonus depreciation doesn't only impact vehicles. You are able to take 100% bonus depreciation on other things outside of vehicles like equipment and, more importantly, real estate. Because here's the thing. I don't want you all buying vehicles that you can't afford just to save on taxes. We want to leverage the tax code to help us minimize our taxes while still maintaining a lot of our cash flow. So one thing I want to teach you all today is that 100% bonus depreciation can be used on more than just vehicles. It can be used on equipment for your business. It can be used for supplies and tables and whatever things that you need for your business is actually going to help your business grow. We just invested in a new $5,000 vibe board, and I'm able to write 100% of that off on my taxes. And having this vibe board and being able to write down examples and teach tax strategies is going to help my business grow, and it's going to help me save on taxes. I cannot urge you all enough to understand that with the return of 100% bonus depreciation doesn't only impact vehicles, it impacts equipment and it impacts real estate as well, which will allow business owners such as yourself to be able to buy things you need and write off 100% of it in the year that you purchase. Number 2 is the enhanced QBI deduction. So what is the QBI deduction? The QBI deduction stands for Qualified Business Income Deduction. And this was a 20% deduction for business owners against the income that they earned in their business. So if your business earned $100,000, let's say in 2024, you would get a $20,000 tax deduction just for being a business owner. And the QBI deduction was slated to go away at the end of 2025. But what this new tax bill did, it didn't only reinstate the QBI deduction, it actually enhanced it, taking the deduction from 20% to 23% in 2025 and for years going forward. So what does this mean for you? This means that if you're a business owner in 2025, and let's say you make $200,000 in qualified business income this year, you are able to get a 23% tax deduction against that income. That would mean you get a $46,000 tax deduction simply for being a business owner. So think about this. If there's an employee earning $200,000 and there's a business owner earning $200,000, this business owner gets a $46,000 reduction in taxable income simply for how they earned the money. And this is why one of my favorite tax quotes is, how much money you make is not important as how you make your money. Making your money as a business owner, especially with this new tax bill, is going to allow you to make more money, but more importantly, allow you to keep more of it with this increased and enhanced QBI deduction. Okay, so let's move on to number 3, which is the enhanced or increased standard deduction. So the standard deduction used to be $15,000 for single and $30,000 for married. Going forward in 2025, the standard deduction is now $15,750 if you're single and $31,500 if you're married. Now, why does this impact business owners? Well, if you've been following me for any amount of time, you know that one of my favorite strategies is the income shifting strategy of paying your children. Paying your children from your business allows you to shift income from your high 37% tax bracket and move it to your child's 0% tax bracket by taking advantage of paying them from your business. And with this new tax bill, you will be able to pay each of your children $15,750 each from your business, and you will get a $15,750 tax deduction, and your children will receive this $15,750 tax free. So the increased standard deduction dramatically impacts business owners who have children if they take advantage of this strategy. Moving on to number 4, and this is huge. 100% deduction of research and development expenses, including a 20% tax credit on those same expenses. So Carter, what does that mean? That means with this new tax bill, you are able to write off 100% of the expenses that are tailored to research and development and the growth of your business. But you are able to double dip by taking 100% tax deduction, but also getting a 20% tax credit for these same research and development expenses. Now, you need to be very careful with this tax deduction and tax credit combination. You need to consult with your CPA, because depending on what you're using these R&D expenses for and what type of business you have is going to dramatically increase your deductibility of these expenses. If you're looking for a tax strategist, check the link in the video and you'll be able to schedule a call with our team, or better yet, join one of our 5-day trainings where we give you all of our best strategies and then allow you to hire us after. So if you're looking for a tax strategist and a financial advising team, click the link in this video so that we can help you out. Now, let's move on to number 5, which is C Corporation tax rates. C Corporation tax rates are now 21%. And they were 21% before, but they were expected to change and increase. But what this new tax bill did is it cemented the 21% C Corp tax rate. Now, how does this affect business owners? If you're a LLC or a S corporation, you have to pay ordinary income tax rates on your income. So if you're in the 30% tax bracket, 32% tax bracket, or 37% tax bracket, personally, that's also what you're going to be paying on your LLC and S corporations, because LLCs and S corps are pass-through entities, which means that the income that you make from your business passes through to your personal return. There is no such thing as I'm going to keep the money in my LLC or keep the money in my S corp so I don't have to pay taxes. Please do not make that mistake, okay? With that being said, with the favorable tax rates of a C corporation, it might make sense for certain business owners to change their tax election status from S Corp to C Corp. Why is that? Well, if you're making $1 million in profit in your business and you have an S corporation, you're going to pay $370,000 of taxes on that income because you'll be in the 37% tax bracket. However, if you make $1 million in profit in a C corporation, you only have to pay $210,000 in corporate tax rates. Now, if you distribute the money from your C Corp, yes, you will have to pay the rest of that money in ordinary income taxes, but at $1 million of net income, you probably don't need to take all that money as a personal salary, which means you can keep that money in the business and use that money to reinvest in the business to allow the business to grow. And now you can have that 16% gap, the difference between 21% and 37%. 7%. $160,000 in this example can be saved in taxes by keeping the money in the business. And actually, one of my favorite strategies is to set up a fiscal year C Corp management company, which will allow you to pay your C Corp from your S Corp for management services. Let's say at the end of the year, your S Corp has $1 million in profit. You can pay that $1 million in profit to your C Corp management company that has a different fiscal year end. And after you pay that money to your C Corp, that money will be taxed at 21% versus 37%. And if you're smart, because the C Corp has a different fiscal year end, it actually gives you more time to spend the money. When we implement this strategy with our clients, depending on when we set up the fiscal year C Corp, we might be able to buy another 9, 12, or 14 months to spend the money that we just kicked to this fiscal year C Corp and allow us to save major on taxes. Now, again, that is an advanced tax strategy. If you want to learn more about that, check the links in the description so we can help you out. But these are 5 reasons that everyone needs to either have an LLC or some type of business in 2025 if you want to win the game of taxes. Because remember, how you make your money is more important than how much money you make. So if you like this video, please do me a favor, hit that like button, smash that subscribe button, and send this to a friend so that they can see how to make more money and save on taxes. Until next time, peace.